Good morning, this is Kim, and I want to give you a brief overview of some bond terms because we're going to be discussing bonds this week. So let's get going. Okay, so here's my bond right here. And like I said, I'm going to talk about some key terms. The first term I'm going to put over here in this corner, and it's going to be par value or face value. Same meaning. And for us, for all our bonds, par value and face value is going to equal $1,000. Okay? So always going to equal $1,000, and that's our first term. Our second term is going to be called the coupon rate. Coupon rate. And that is, the coupon rate is the interest, the annual interest. So make sure you remember this, that this is annual, paid on the bond. So the annual interest paid on the bond. Okay, our next term. Our third term over here is going to be called the maturity date. Okay, the maturity date here. And what this is this is the date that par value is paid back. Okay, is paid back to the bondholder. All right, so let's think about it like this. So let's say this bond was issued by PG&E, okay? Because PG&E issues bonds. So on this day, PG&E issued new bonds. And let's say you went and bought the bond when they were first issued. So you bought the bond for $1,000. And let's say you held the bond for 1 year. So if you held the bond for 1 year, for example, and the interest was 6%, or this coupon rate was 6%, then you would have earned in 1 year 1,000 multiplied by 0.06 equals $60. Okay? So in 1 year you earned $60, and then at the end of the year, let's say that was the maturity date, so it was July 2nd, 2019, you would have received back, you would have received back $1,000, because remember, par value is always paid back at maturity date, and par value is always and forever $1,000. Okay, so that's how a bond works. So I'm going to go back here for a second. And you should recall this shape. Okay, we talked about this last week. This is the investment period. Remember, it has 4 different levels with a risk continuum over here. Up here is high risk, if you remember, and down here is low risk. And we talked about everything in this box. Remember, these were CEs, cash equivalents. And then at this next level, we had bonds. All right, bonds being lower risk than anything up here. This was stock. Okay, stocks being higher risk, but bonds being a little bit higher risk than cash equivalents. So again, for that higher risk, we would expect a higher return. Okay, that's how this goes. Every time you assume more risk, you expect a higher return. So now in here, we're talking about bonds. And like I mentioned up here, a bond is, in effect, really in one word, a bond is a loan. So a bond is a loan that you make. So when you buy a bond, you are effectively giving a company or giving the government a loan for a certain amount of time. At the end of the time, or the maturity date, the government or the company repays you the loan back. And in our case, they repay par value or face value, which is always $1,000. Okay? So that is generally how bonds work. So I want to now go beyond that a bit, and let's say, so let's do an example. Let's say that you still buy a PG&E bond, and let's say the maturity date is now, in our example, we have PG&E. It has a maturity date in 3 years. So let's say it matures on July 2nd in 2021. And that the coupon rate, so their coupon rate is 8%. Okay, so we buy this bond today. So we have in 1 year, 2019, 2020, and 2021. So in the first year, 2019, we want to know how much money we're going to make. So we're going to earn 8%. Remember, the coupon rate is always, the formula is par value multiplied by the coupon rate. So in our case, our par value here is $1,000. Our coupon rate is not 6%, but instead it's 8%. So our annual coupon amount is going to be $80. So in 2019 here, we're going to earn $80. And in 2020, we're going to earn another $80. And then in 2021, we're going to earn $80, plus we're going to receive our $1,000 back, our par value. And so up here, actually, we gave them $1,000, so we are negative. So that's how a bond works. So when you think about, well, how do I make money in bonds? Well, I'm mostly making this interest payment. For right now, I'm just making this $80 a year on my $1,000 investment, and that is my annual return is this 8%. So lots of individuals buy bonds, and they buy them primarily for this interest payment. Because as we all know, PG&E is a good company. PG&E has been around forever. And the likelihood that PG&E will pay their 8% annual interest payment is high. So lots of people want to buy bonds because of the relative safety that they offer. So that in a nutshell is how bonds work. Now I'm going to throw a little wrench into this. So I'm going to scroll down here. And again, this is just an introduction. I'm not going to get into detail until our Thursday homework. But remember how I told you that par value, so PV par value, is usually $1,000. However, bonds trade on exchanges just like stocks trade on exchanges. So the likelihood that you're ever going to be able to buy a bond for $1,000 is high, or is very low. I'm sorry, you're not going to be able to buy it for $1,000. Instead, with bonds trading, there are two terms. So bonds either trade at a premium, which is greater than $1,000, or a discount, okay? Which means that they're trading at less than $1,000. So for example, a bond, that the price you may pay might be $960, or the price that you pay might be $1,050. So again, they're trading somewhere around $1,000 perhaps, but probably never at $1,000. So now that you know that bonds trade at different prices that are not par, I want to go through one more example. I just want you to think about this. So let's take our same bond. Okay, so we have PG&E, and it's 8%, or 8% coupon, And we still have that maturity date of 2021. Okay, but now we're going to say that the price, let's say that we are going to pay $1,050. So right now the bond is very desirable. It's trading for higher than par value, $50 higher. And we're willing to pay $50 higher because it's still a really good bond and we like the 8% coupon rate. So going back here, year one, so this would be, I'm going to put these as years, 2018, 2019. How about we start 1 year from now, 2019, 2020, and 2021. So how much money am I going to make? So in this year, by 2019, I'm going to make my $80 in the coupon rate. Remember, I'm initially out, so I spent $1,050. And in 2020, I'm going to earn my $80, and here, 2021, I'm going to earn my $80, plus I'm going to receive back par value. Now, par value, always and forever on bonds, is $1,000. Oh, but wait a minute. I paid $1,050. That's right. You are only going to receive back $1,000. So the extra $50 you paid is money you're not going to return. You paid a premium for this bond because you liked all the other features, but you do not receive that $50 back. So here's a thinking question, big thinking question. So when we look at the coupon rate of 8%, the question is, did you actually receive a return on this bond of 8%, or did you actually receive something lower than 8%? Did you receive something lower than 8%? And what does it have to do with the price versus par value? So I just want you to think about that. And I think that's all I'm going to do today. So like I said, this was really short. It's just an introduction. You have another video to watch from Khan Academy and answer a few questions and get ready for that tax quiz that's coming up on Thursday. So have a great holiday, and I'll talk to you again soon. Bye.